Good afternoon, everyone. My name is Esther. I'm from the Intermediary Business Development team at Nikko Asset Management. Thank you for being here today and joining this session. Today, we have with us Grace Yen, Senior Portfolio Manager at Nikko Asset Management. And in the next 20 minutes, we will be having a fireside chat talking about investing in Asia's smaller companies, also known as small caps. Why should investors be looking at small caps? What is the outlook? And why are smaller companies like diamonds in the dust? So Grace, let's start off by talking about what happened last year. 2023 was a tough year for markets. Could you do a quick recap and let us know what your outlook is for 2024?
Thanks, Esther. Hi, everyone. Thanks for coming. So maybe let's look at a quick recap of what happened in markets last year. So there was a lot of macro uncertainties and geopolitical risks as well. We did see China underperforming, US and China tensions. Markets were pretty volatile. But it was all not doom and gloom. So there was also bright spots as well. So we saw the rise of artificial intelligence, with ChatGPT. And why that was such a huge thematic was because ChatGPT actually only took 2 months to reach 100 million users. And when you contrast that with Instagram, that took 2.5 years. So you can see the rapid adoption shows the huge opportunity as well as growth there. So turning our attention back to the markets, so behind you can see the charts of the performance of some of the equity markets last year. You can see that US actually had very strong performance. However, if you exclude the Magnificent Seven, actually performance hasn't been that exciting as well. And turning our gaze back to Asia, we can see that small caps actually outperform large caps. And actually small caps outperform large caps by 13% actually last year. So we can talk a bit about why that happened last year. And also, I guess moving forward for 2024, it's a great election year, right? This year we have the US elections, the India elections, Taiwan, Korea. So how should we kind of be positioned when we look at 2024?
Thanks for setting the scene for us. You've been managing the seed fund that we're talking about here today. You've been managing it for more than 5 years now. And your focus has always been on Asia's smaller companies. So you're really the expert here. With what you have shared with us with this environment, how do we actually navigate this environment in terms of how we should think about investing in smaller companies? What are some of the themes, some of the trends that are favoring smaller companies here in Asia?
So we've identified 2 mega trends that we think can help to navigate the choppy environment. So the first mega trend being millennials and Gen Z as the rising consumption force. So millennials and Gen Z are youths born from 1981 to 2012. The second mega trend we've identified is the rise of entrepreneurial companies. So looking at the first mega trend, so Asia, we know, has the best of both worlds. So firstly, 60% of the world's population actually lives in Asia. So we don't have a shortage of workers. Actually, we have a huge workforce, unlike the developed markets. In addition, we also have a large consumer base, which is positive. So by 2025, MZ generation will account for about 50% of APAC consumers. So for companies, it is important to understand this demographic. And these MZ consumers, basically, they're digital natives, so they're often glued to their phones, they're trendsetters, and they also seek unique experiences. So it's important that you understand their behavior and kind of adapt to them. So we think that smaller companies will be able to adapt and respond quickly to these trends as they don't have bureaucracy and they're more nimble. So on the next slide, you can see, so millennials and Gen Z in general are also less impressed by foreign brands. So in China, for instance, we've seen domestic brands gaining market share. In the last 10 years, the Chinese cosmetic brands have gained market share from 12% to 24%. So I think it's imperative that companies kind of focus on this demographic. And we think that smaller companies are well suited to respond quickly to such trends. So moving on to the second mega trend, which is the rise of entrepreneurial companies. So in Asia, we know that family-owned companies actually account for 85% of businesses compared to only 40% in the US. So we can see that there's a huge difference there. In addition, family-owned companies have outperformed non-family-owned companies. And in particular, smaller and mid-sized companies in Asia also have outperformed larger-sized family-owned companies in the long term as well. So if I draw your attention to the bar chart on the screen, basically that's the number of companies that have listed in the past 10 years, and you can see that Asia ex-Japan constitutes the bulk. So that means that there's a huge universe of stocks that we can choose from here in Asia ex-Japan, and that's a huge pipeline that we can look at. So there's a huge opportunity set in Asia, and in addition, Asian companies also have the largest proportion owned by insiders. And why that's important? Because when you own a company that's also owned by insiders, it means that your interest is also aligned because you are investing along with the management of these companies. So all in all, we think that these two megatrends will be supportive for smaller companies to grow and do well.
Wow, that's actually quite interesting, because while we may be aware of millennials, Gen Z as a rising consumption force, it's actually interesting to see that in China, it's the domestic brands that are gaining market share. So while investors may be familiar with investing in Asia, they may not be so familiar with investing in smaller companies in Asia. So why should investors actually be taking a closer look at investing in Asia smaller companies?
So if we look at the performance of smaller companies since 2000, actually small caps have outperformed more than half of the time. And so the dark green bars here represent the index MSCI Asia ex-Japan, while the light green bars represent Asia ex-Japan small caps. And you can see here that in the yellow boxes that we've boxed up, those are the periods of outperformance which small caps have done better than large caps. In addition, you can see that during the periods of outperformance, it's actually pretty significant. So small caps do have their benefits. So if we look at the next slide, so why do they offer different performance and benefits as well? So small caps actually offer diversification. So this is a breakdown of the index by their country as well as sector. So you can see from this chart that China actually accounts for about 30% of the large cap index. And when you compare that to the small cap index, India accounts for 30% of the index in general. So you can see that adding a small cap fund to your portfolio actually offers diversification benefits. And that's also one of the reasons why small caps outperformed last year. We all know that China hasn't been doing well. So in contrast, small caps with a lot of exposure to India did better. Sector weights are also pretty different. So in terms of exposure, you're not getting the same exposure as your large cap funds, but you get different exposure. So here we can see that large caps have a larger proportion in financials versus small caps, which have larger proportion in industrials as well. In terms of concentration, it's also pretty different. So if you look at the top 10 stocks for the large cap index in general, it accounts for 27% of the index. So it's a pretty concentrated product that you're looking at. But when you look at small caps, according to the index, only the top 10 stocks only account for 3.7% of the index. So you can see that small caps in general are pretty well diversified. So that's pretty different as well. And moving on to the next slide, we can see here, so more than 65% of stocks are actually covered by less than 5 sell-side analysts if you focus on the chart on the left. So why is that different? So in general, we want to look at stocks that are less well covered because it means that they are less well known and they also have a higher chance to trade away from their intrinsic value. So when you compare that to large caps, right, on the pie chart on the right, about more than 60% of stocks are actually covered by more than 11 analysts. So what that means is that a lot of people cover these stocks, and so there's not much more you can find out about the companies because it's already very, very well covered. So they tend to trade closer to their intrinsic value. So that's why we think that smaller companies are a bit like diamonds in the dust, and basically, we can hunt for them before people find out about them. So kind of think about it as looking about your favorite restaurant. So for example, if there's this restaurant that you really like and everybody knows about it, right? Chances are it's quite expensive. You probably have to wait like 2-3 weeks to get a table, more than an hour. But if you have a restaurant that you like but nobody really knows about and it's kind of like your little hideaway, then chances are prices pretty reasonable and you don't really have to pay a high price for it. So, that's why we kind of tend to look at smaller companies because these are like diamonds in the dust that we want to look for and invest in.
That's a really good analogy, Grace. As a foodie myself, I'm always on the outlook for good food. It's always good to find a good restaurant before anyone else hears about it. And similarly, when it comes to investing, we want to invest in the companies that are diamonds in the dust before the market actually recognizes it. So you manage the Nikko AM Shenton Emerging Enterprise Discovery Fund, also known as the SEED Fund, which is an IFAS recommended fund. Could you tell us a little bit more about the investment philosophy, how your fund is unique, and what makes it actually stand out.
So here at Nikko, our investment philosophy centers on two main areas. So we look for companies that can deliver sustainable returns and or positive fundamental change. So what do we mean by sustainable returns? It could be things like companies with high ROE, so return on equity, or companies with strong balance sheet. And when we look at positive fundamental change, so the things we could look at is things like change in policy or change in management. So we then overlay that with an ESG lens as well. And I think particularly for smaller companies, a lot of companies don't have ratings on public sources. So it's very important that the analysts kind of do the analysis themselves, meet the companies and learn more about them. In addition, we also overlay that with a valuation lens as well. So valuation is definitely important. And in general, that's how we look at stocks. So maybe moving on to the next slide. So this is some of the key characteristics of our fund. So our fund is a bottom-up stock selection basis. So basically, our sector and country weights are more a function of where we find the best ideas rather than others. And also, 37% of our stocks have analyst coverage of less than 6. So like I mentioned, we are looking for companies that people don't really know about. And 45% of the portfolio is in non-benchmark stocks as well. So our benchmark, for reference, has about 1,000 stocks, and yet we can still find a lot of stocks that are not in the benchmark. So I think that's what makes us a bit different. 38% of our portfolio are in companies with market cap of less than $1 billion. And why that's important is because most of the large cap mandates probably only can buy stocks that are above $1 billion. So basically, we buy the smaller companies and be positioned in them earlier, and then we can ride with them as they continue to grow, as more people can invest in them. Lastly, about 57% of our portfolio are in net cash companies, and that's important because basically, with the uncertain interest rate environment, our companies all have a very strong war chest, and they can, look for M&A opportunities or investment opportunities without worrying about borrowing costs.
So one of the top holdings in your fund is a company called 𝗑𝗲𝘀𝗁. And I believe this is one of the stocks that have done pretty well in terms of adding performance to the fund. Show of hands, who has heard of this company, 𝗑𝗲𝘀𝗁? I think some of the females in the audience probably has heard of it. Is anyone here wearing any makeup from 𝗑𝗲𝘀𝗁? No? I believe they're quite well known for like an eyeliner that they're very famous for. So, Grace, could you tell us a little bit more about this stock that you actually hold in your portfolio, and what do you like about it?
So 𝗑𝗲𝘀 is a company that we've actually kind of followed since they've listed in 2016. So it's a company that we know very well. And maybe if you've been to Korea pre-pandemic, I'm sure if you've been to Myeongdong, then you remember that there are a lot of cosmetic stores and the competition is very intense. So 𝗑𝗲𝘀 is one company that's actually survived this competition. So there are a lot of other brands, I'm not sure if anybody remembers, but like Skin Food or like Nature Republic, some of these brands that we don't even see today. But 𝗑𝗀𝘀 is a standing example of a survivor, and why they've managed to survive. It's because they've been very innovative in terms of coming out with new products. So for example, during the pandemic, they came up with a mask-proof foundation. So basically a foundation that won't stick onto your mask, your face mask while wearing it. And like we talked about MZ generation as well. So they've also launched a brand called 𝗬𝗲𝗰𝗲, which is basically the word good plus all pieced together. And the MZ generation likes it because it's a vegan brand. It focuses on clean beauty, some of the attributes that these young people can ascribe to. So they can come up with strong products. So product innovation is one of their strengths, which we think helps in terms of sustainable returns. They're also very strong in terms of distribution channel. So in China, for example, they're one of the first few companies to exit the offline channel. So they realized that the Chinese youth of today, they focus on online channels like Tmall, 𝗪𝗉𝗄, and so they've used that as their main marketing channel, which I think has proven successful for them as well. In Korea, they focus on health and beauty channel. So Olive Young, I think, is the biggest health and beauty channel and the most fastest growing in Korea today. And they do have a lot of key products that are ranked very highly, like their foundations as well as their eyeliners. So I think focusing on these channels are positive for them. And in terms of new markets, they're also looking at like US or Japan. So for example, if you go to Japan today, if you go to like Donkey or Lawson, you will see a lot of their products present in these markets. So the company is very nimble. They've always kind of looked to new trends and they're looking ahead. So we think that's very positive. They're also very conscious about ESG. So 𝗬𝗲𝗰𝗲, the brand that I mentioned, it was the only Korean cosmetic brand to be selected in 2021 for sustainable brands by the UN SDG. So I think that's pretty important as well.
Thanks, Grace. That was really interesting because we would think of 𝗂𝘃 as something that we buy, but actually there's so many other things that we should look at them in terms of something to be able to invest in. So on this next slide, just to share with everyone the top 5 holdings of the fund, and that includes 𝗂𝘃, which is one of your top holdings. The other names might be a bit more unknown to most people. So unlike other Asia equity funds that you may be familiar with or investing in already, what these funds actually invest in is different names. And this drives home the point what we were talking about earlier about diversification. Grace also mentioned about megatrends earlier, so we can see some of the top 5 holdings here, how the stocks are actually supported by a megatrend. And the 2 charts below showing the country allocation and sector allocation, as mentioned before, unlike most other Asia funds which invest in large cap companies, you can see here the country allocation is quite different, with the top 3 being Taiwan, India, and South Korea. That said, the sector and country allocations are actually a function of where Grace and the team actually finds the best ideas. So to summarize what we have covered today, why invest in Asia smaller companies? Firstly, to participate in the growth in Asia, supported by the 2 megatrends, which is millennials and Gen Z as the rising consumption force, as well as rising entrepreneurial companies. Secondly, to benefit from the agility of smaller companies to be able to adapt to trends. Thirdly, we spoke about portfolio diversification as well. This is a good way to diversify if you currently already have existing exposure to Asia. And why our Nikko AM, Shenton Emerging Enterprise Discovery Fund, also known as the Seed Fund. We think you should consider our fund as we have a good track record and with multiple awards and recognition. So please note, of course, the product suitability and the risk, key risk when it comes to investing in smaller companies. Do scan the QR code here for more information on our fund, or please feel free to visit our booth, which is at the back, and speak to any of us there. Thank you very much for your attention and hope you have a good day ahead. Thank you.
Thank you.